Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, writer at CTMfile. Welcome, Paul and Ben, to this episode of the Open Treasury podcast.
Thanks, Push.
Yeah, thanks for having us, Push.
Thank you so very much for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely emerging technologies that matter for corporate treasury and their impact on treasury management systems, HSBC builds tokenized deposit-based treasury management capabilities, US truck freight spending drops for 5th consecutive quarter, and finally, UK fund managers prioritizing foreign exchange hedging despite lower volatility. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's begin today's discussion with the first story, which is about emerging technologies that matter for corporate treasury and the impact on treasury management systems, or TMSs. Whether to their chagrin or to their delight, treasurers are increasingly finding that they must have a fairly high level of familiarity and capacity with technology. While there is an abundance of information available about technology online, it is typically too deeply technical, too broad, too out of date, or too lacking in relevance to treasury to suitably fit the need, stated Strategic Treasurer's 2023 Treasury Technology Analyst Report, which can help fill this gap while also helping corporate treasuries stay up to date in the current context. Paul, can you throw more light on Strategic Treasurer's 2023 Treasury Technology Analyst Report and how you think it can act as a definitive guide to treasury practitioners exploring how treasury technology meets treasury needs?
Sure, Push. I mean, there's no doubt that treasurers have to be more savvy when it comes to technology. That's not going away. As a matter of fact, we're seeing that it's accelerating. We're going to continue to see that phenomenon happen, whether it's movement, you can remember years ago, movement from, hosting or a host-to-host platform to a SaaS-based platform, software as a service. Now we're moving to PaaS, platform as a service, cloud-native platforms where you have the ability to create updates on the fly, so you don't have to wait for the periodic intervals that you get with other platforms. It's increasing the speed at which technology development is occurring, and it's really beneficial to customers, clients in particular, treasury platforms where an organization is growing and they have new demands put upon them. Things can be shifted and changed quickly, and this can be delivered across the entire platform. The other thing that we're seeing with AI, APIs, and machine learning, so I'll start with APIs. So APIs are becoming the new mode of connectivity. Traditionally, it used to be host-to-host platforms through an SFTP, where you could share encrypted, secure file transfer. And it was all managed by IT services within an organization, either going from the organization or from a bank or treasury service platform. What we're seeing today is in between there, I should say that, a lot of platforms started moving to Swift connectivity, where you could do information reporting, payments. There are requirements to be able to do the payment side of things. You have to have a Swift BIC in order to do that, or you can leverage somebody else's platform. That allowed for easier connectivity than host to host. But now with APIs, this is really changing things rapidly, and the connectivity process is becoming a lot faster, not only for information reporting, but also for payments. The thing is that it's still evolving. So our tier one banks, the $1 trillion banks, the big banks, a lot of them have stable APIs for doing these types of connectivities. And what we're seeing is that it's the technology side of the equation that is working to catch up. So it's either your treasury aggregators, your treasury management systems, they're working to catch up on the API platform. So they're a little bit behind, but they are engaging in doing that kind of connectivity. What makes that important is the speed at which the connectivity can happen. So once certificates are exchanged and that secure connection is made, it's done. It becomes agnostic to what you're sharing across the pathway. And so it makes it really quick. It's speeding up the way systems, platforms are connecting and interacting with each other. I'll move next to AI and machine learning. Artificial intelligence with ChatGPT coming out, it just exploded. AI just went crazy. We've seen it the last 12 months. It's been exponential. It's become a more important thing for organizations to get their arms around. This is learning for treasurers, learning for senior management teams, boards, IT services within an organization, risk services, all these things that you got to think about when it comes to AI, how you can ensure you have belt and suspenders so that the use of AI is used properly. Machine learning, where it can learn from data and information that's coming in. It can decipher things, anomalies. You can use AI and machine learning to sift through all the data, transactions that come daily from bank files. You can sift through that, see if there's anomalies, determine as a potential for fraud. It can help with fraud. It can also help with you forecasting cash. These tools are going to become more and more prevalent. So when we think about risk mitigation, when we think about the ability to move at a rapid pace and provide more visibility, technology is key for treasurers. I know I went through a lot real rapidly, but this report that we put out annually, it's really important, I think, to our industry, to our clients, prospective clients. This really gives you a lay of the land, gives you the information that you need to know. Really an important report.
Yeah, that's fascinating analysis, Paul. I definitely agree with you in terms of the report. It's well worth a read. And I was particularly interested and kind of happy that APIs were kind of in the spotlight as one of the kind of the key sort of innovative technologies in the treasury space. I think relatively simple piece of technology, but pound for pound, what it can help treasurers achieve. You know, APIs help to ensure that all the relevant data a treasurer needs to do their job is pushed to them rather than them having to go and take the time and effort to go and find that data. So the ability to get data in real time, particularly if your treasury department, you know, has thousands of bank accounts across various banking partners, that could be a real breakthrough for corporates on their kind of digitization journey. And that gives the treasurer real-time visibility over their cash. And not just their cash, you know, it could be payments, it could be account statements. There are use cases for APIs around data intelligence and like ERP, TMS connectivity to improve things like forecasting and working capital management, even virtual accounts that are connected via API. So it's huge, I think, for treasury, the API for what it is as a piece of technology. We have noted on this podcast before, kind of the challenge perhaps of the lack of standardization across the various proprietary bank APIs. But there's a couple of things that will help with that. Obviously, you were mentioning the technology platforms, the TMS providers. You know, I think they're all working quite hard to try and present a single point of information that treasurers can look at and have all of their various bank connections pulled in there. And hopefully also on the kind of the data side, the adoption of ISO 20022 will hopefully start to also increase the standardization in this area. But yeah, a really fascinating report, I think. So well worth anyone listening to kind of go and dig that out and have a read of it.
Yeah, I think, one thing you noted there with regards to speed, this is a huge benefit to API connectivity for information reporting, because the traditional way of connecting, it's you set up intervals for receiving those files. The banks send them when you say send them. The system says go look for the file at these times. It brings them in. And so you can get that done periodically throughout the day. But with the API connection, it's instant. At any moment that you want to receive that information, you can get it. So you don't have to wait. And it allows for treasurers to account for activity that maybe they weren't anticipating that was going to occur during the day, and it happens to hit the accounts. So I think, that benefit of API connectivity is, it's more than just being speed of connection. It's speed of information. It's the constant flow of information. It makes it super valuable to treasurers.
Yeah, reduce surprises. The last thing you want is surprises. So if you can get that information as it's happening and be able to act on that information, that's so valuable.
That's so valuable. Thank you so much, Paul and Ben, for your terrific insights when it came to treasury technology. To help treasurers keep their ears to the ground and discover how they can make treasury technology work for them, I would recommend treasury executives download, review, and benefit from Strategic Treasurer's 2020-23 Treasury Technology Analyst Report. You can visit strategictreasurer.com and download the report. Let's shift our conversation from treasury technology to our next story, which is about HSBC successfully testing the use of tokenized deposits in intra-group payment transactions together with Ant Group. This initiative, the first of its kind in Hong Kong, aims to explore the potential of deposit tokenization in enabling always-on real-time treasury fund movement between accounts held by a corporate within the HSBC network. Ben, you covered this story for CTMfile. From your perspective, how do you think HSBC's deposit tokenization initiative can help corporate treasuries within their network?
Thanks, Push. Yeah, it's a fascinating initiative between HSBC and Ant Group, which obviously is very famous around the world as being a leading open internet platform that's got a real focus on digital products and services. So it's perhaps no surprise it's a company like that that's involved in this sort of initiative. I think it kind of highlights the potential of blockchain technology to enable digitalization, both of sort of industry collaboration and innovation of value movement. The project has significantly improved the efficiency on liquidity and corporate treasury management, as well as, I suppose, a side effect is it shines a spotlight on Hong Kong's position as quite a significant corporate treasury hub globally. Thinking about this, blockchain has had quite a rough ride in one area, the supply chain space, where we've seen several blockchain platforms that were backed by the banking community fold in the past 18 months. Notably Contour announcing last week that it's shutting down at the end of this month. So we know that blockchain technology isn't a panacea for all treasury solutions. But clearly in this scenario, Ant Group and HSBC, they found a use case here for the issuance, transfer and redemption of deposit tokens. If this is a way to enhance treasury fund transfers with improved turnaround time, more efficient costs and getting that visibility, then clearly it's an area to keep exploring. Not all companies will be in a position to look at a solution like this today, obviously. But when you've got trailblazers in the corporate space, in this case, Ant Group, it really does, I think, open up possibilities for treasurers everywhere as banks start to put in place solutions for corporate leaders in this kind of scenario. The benefits can sort of cascade down to other corporates. So it's always interesting to see those right at the forefront of technological development, trying to break through and define what tomorrow's treasury is going to look like.
Yeah, I think you said it quite well. I'm not sure I can add a ton to this other than what I like about this article and what HSBC and group is doing here is that they're testing the use of technology for something that we anticipate should happen. When we think about tokenized deposits or transfer of tokenized value, whatever that happens to be, or a CBDC, this just proves that the pathway is viable, that it will work, that it's efficient, provides you with the necessary visibility. So it's a matter of, who's going to take that first leap, utilize a platform driven by blockchain, which this shows that blockchain is still valuable. It's the people on this podcast realize blockchain does have value. It's a matter of demonstrating and showing its applicability. Obviously, as you pointed out, Ben, supply chain finance use of blockchain didn't pan out the way that folks anticipated. I don't know offhand, maybe you do, Ben, did somebody go through the process to test it before they deployed it? It almost feels like maybe there might have been too much speed to get something to market before the market was able to digest the use of it. In this case, it's, hey, let's test it and make sure that we can take it to market. Now it's a matter of getting the market to buy into that this is the right application. It feels like it is. It'll be interesting to see how this continues to play out. I'm hopeful. This is the direction we're going to end up going worldwide. We are going this way. And for people to sit on the sidelines and think, oh, we're not going to go that way, or there are all kinds of challenges that have to be addressed, obviously. But this is a direction that the world's going to end up going.
Absolutely. And I think there'll be other use cases as well. If you think about blockchain for payments, for real-time payments, it's another option that I think some corporates are looking at with their banks in terms of what can be done there. As you say, it's certainly not a dead technology. There's life in blockchain yet.
From deposit tokenization and blockchain, let's move forward to our next story, which is about the US truck freight economy, which is witnessing another challenging quarter. During the third quarter, the amount spent to ship goods via truck freight was down 12.5% compared to a year prior, while the volume of shipment was off 9.7% according to the US Bank Freight Payment Index. Spending fell 4.2% and shipments declined 3.4% from the second quarter to the third quarter of 2023. This marks the fifth consecutive quarter that both truck freight spending and volume have declined. Paul, is a slowdown in manufacturing and supply chain activity contributing to the decline in the US truck freight spending, or do you see some other factors that are impacting the truck freight economy?
Well, I think there's a variety of things that contribute to this push. The first thing that I would say is that from a global standpoint, there's challenges out there given the relationship we have with some of our suppliers overseas, wars that are going on, issues that organizations are having with their economic position. Within the U.S., what we're seeing is that the Fed tightening has been working. The rise in rates is had an impact not just on corporations, but on individuals. And inflation continues to be persistent. It hasn't gone away. It's still there. It's not talked about as much, but it's still there. So we have higher interest rates. We have inflation. It's costing consumers more to do the same. And so we're seeing that they're starting to pull back. They're starting to conserve. Yeah, rightly so. That's what we want. We want to slow down the economy. The only way you're going to get there is to institute the things that the Fed has done to try to slow things down. And so I think this is just evidence of what the consumer is reacting to. It's reacting to everything that's going on around them. And it's the kind of reaction we want to see. Now, is it painful? Yeah, it's painful. It absolutely is. And, organizations should have been prepared for this kind of contraction. I think we're going to continue to see lower levels of volume, I don't think we're going to see things all of a sudden pop back up in the near future. So this is the kind of economic trend that I, expect to see. So it's not necessarily surprising.
Yeah, it's a really interesting data point, I think, to look at. Obviously, freight is basically the physical backbone of an economy, often the final link in the supply chain. So that's why it's interesting to have a look at this. Worth noting that the decrease in the third quarter was not as severe as Q2 on the US bank freight scale. In Q2, that was one of the sharpest drops they'd seen since the early days of the pandemic. So in relative terms, Q3, that's not so bad in terms of these latest results. Obviously, as you touched on there, Paul, weaker consumer demand for goods and slowdown in manufacturing activity and housing starts having a major impact on industry, and that has a knock-on effect to carrier operations. It was interesting to see the regional breakdown. They kind of flagged up the most notable decline was in the Southwest, which experienced the first quarterly decline in shipments since early 2022. Indeed, shipments there had increased 17.3% over the previous 5 quarters. So they really got hit by a decline in home building and cross-border truck transportation for this particular quarter. And perhaps, the economic growth in the US, as seen in the above expected Q3 GDP advanced estimate, might start to filter through the overall economy, and as you say, the connection of the freight sector to that. So often it's a bit like an oil tanker turning around. It takes a little while for to get lined up to where you're going next. So it'll be interesting to as we've just compared Q3 to Q2, to have a look early next year at what the Q4 index says and whether this is kind of the bottoming out of the decline in that regard.
Kind of feels like, we're approaching a bottom or, a near term kind of new level of volume. I think that's where we're going to be for a little bit. Could we see a pop back up, later in 2024? We could, in particular, if we see the Fed taking some kind of action, which, it's interesting. I was just reading on Bloomberg, markets have been anticipating that the Fed might reduce rates sometime in the near term. And now they've come to the realization, the Fed's not going to do that. So stocks are taking a beating today. All right, let's get to dose of reality and what we think is going to happen. But, markets react to what's going on out there, but consumers react to these movements that the Fed make. And so Fed starts doing things to make interest rates lower. People start thinking about, I'm going to engage in activities I hadn't done before. I'm going to build a home. I'm going to remodel my home. I'm going to buy cars. I'm going to buy goods and services. I'm going to take out a loan to do this. The banks are going to start, increasing money supply. The money supply multiplier is going to increase. All these things that start fueling, an economy where demand for goods and services will increase, which will have an impact on volumes here in this article. So, it's basic economics. If you keep it simple, it tends to be easier to grasp a hold of, what's going to happen. It can get very granular and very complicated, but, I think 4 quarters from now, it'll be interesting to see what happens. I think it's going to take some Fed action before we see these volumes start to tick back up in any significant way.
Great food for thought, Paul and Ben. An interesting analogy, Ben. Our next story that warrants discussion is about UK fund managers prioritizing foreign exchange or FX hedging despite lower volatility. A report from Miltech FX has revealed that 3/4 of UK fund managers hedge their currency risk, and out of those that do not, 95% are considering doing so given market uncertainty. The Miltex FX UK CFO FX Report 2023, The Intensifying Challenges for Fund Managers, found that although volatility has decreased since peaking towards the end of 2022, the share of fund managers hedging a large proportion of their FX exposure grew from 46% in 2022 to 56% in 2023. Ben, you wrote this story for CTMfile. Do you think UK fund managers are prioritizing FX hedging because of British pound's volatile trajectory amidst ongoing economic uncertainties?
I mean, I'm sure that has something to do with it, Push, definitely. Wherever you're based, your domestic currency and its performance can impact your global operations. So what I thought would be quite interesting to do would be to look at this survey, which, as you say, is for the UK perspective. And Miltech FX carried out a very similar survey with North American CFOs a couple of months previously. I think it was September that came out. Just to have a look at some of the differences between the UK and the US. So in this report, the UK, the average hedge ratio was between 40 to 49%, and 68% of fund managers citing this as higher than last year. And in the US, the average hedge ratio was a bit higher. It was between 50 to 59%, but a very identical percentage, 69% in the US actually stating that it was higher than it was last year. So clearly on both sides of the pond, that sort of more active risk management is taking place. In the UK, 77% said their returns had been affected by volatility in the pound. But actually, in North America, slightly more, 82% said that US dollar volatility had impacted their business. So it's not just it's a pound thing. It's like you say, I think the market volatility that you mentioned from late 2022 has certainly fed into what's happening today. And it's just kind of really put risk management back on the map. And often it takes a little time to react to these things as they're happening, depending on, the sort of position and often the technology that you have involved. A lot of these fund managers will be dealing with a very sophisticated tech stack, I would suggest. So it might be quite easy for them to just kind of up those ratios and just also look at the processes as well as the technology. What's our culture to hedging in the organization? Does that need to change? Do we need to rewrite our policy a little bit to account for some of the volatility that we're seeing? And a lot of those themes will, I'm sure, be quite familiar to corporate treasurers who go through this as well, a lot in their kind of day-to-day and month-to-month operations. So I think overall, this research is being used to reinforce the importance of fund managers having a transparent view of their FX execution and kind of simplified workflows. And again, just really having that strong risk management strategy in order to protect future returns.
Yeah, man, no doubt. This is not surprising to see, what came out of this survey here. It's no different than what a treasurer is going to do. And treasurer's looking at their FX exposure. It's, okay, what's the cost of engaging in the hedge? How much risk do I have? How much risk do I want to take off the table? And what's the right risk to actually hedge? You don't want to necessarily hedge everything because it may be, one, cost ineffective, or two, the volatility may not be as significant in one area versus another. So it's a matter of, really taking a look at risk in totality. So not surprised by this because we have had a lot of FX volatility. We did have some calming, as the article pointed out. We did have some calming, but volatility still remains quite high. And if we continue to have geopolitical disruptions, trade wars, other economic things that could impact or downturn, an economy on a global basis, I think we'll continue to see higher levels of FX volatility. So now it's a matter of, what risk are you going to manage away, or at least try to control, I used the analogy earlier, belt and suspenders, trying to make sure you got the right risk that you're hedging. And, costs have gone up for hedges because the volatility's gone up, the risk for the counterparty's gone up. So naturally, the pricing goes up. So it's manage the right risk. And as we continue to look over the next 12 months, I think we're going to see higher levels of hedge ratios because people are looking at their risk management programs, fund managers, treasurers, otherwise, and they're going to put more hedges in place and accept less volatility of the currencies out there for where the risk really lies.
Yeah, 75% of fund managers in the UK said that the cost of hedging had increased over the past year, and that was more than North America. In fact, the number was closer to 2/3. I think it was 67% in North America, but still both overwhelmingly say, yeah, prices are going up to do this.
They sure have. Tons of evidence out there showing it. I mean, it's just natural economics. It's the way it works. Volatility starts calming down. You'll see pricing go down, but you also see the hedge ratio come down because, they won't need to necessarily manage as much risk. They'll continue to manage the right risk, but not everything. So this is a good article. It really kind of shows a direction relative to, whether it's US or UK, we're kind of in the same boat, relatively. And, it's not something, it's just a phenomenon for us alone. I mean, whether you're in Asia or South America or Africa or wherever you're at, I mean, currency volatility is an exposure for everyone on a global basis, given the global economic footprint. Definitely something people have to pay attention to.
Finally, what is your choice, gentlemen, for the biggest or most important story of the past week and why? Paul, can I ask you to do the honors first, please?
The one that really sticks out for me, Push, I think the article on our Treasury analyst report, I think is really an important thing. I encourage people to go to our website, download a copy of the analyst report, take a look at it. We have some new vendors that are part of the analyst report this year, some newer technology. I think it will give even people that have read our prior reports, it's going to give them a new flavor for what's available out there. So I think they'll find a lot of value in this report.
Yeah, I'd echo what Paul said and point to the report. And also, I think, we covered a lot of different technologies in the first two stories that we spoke about today. And they all kind of point to the sort of more real-time nature of banking and finance that treasurers are having to deal with. So it's really important to familiarize yourself, if you're not already using some of these newer technologies, with what's out there, and also reflect on your own processes where these types of technology might be able to get you some quick wins. That's always important if you're trying to get budget for a new IT project. If you can point to, okay, well, we can do this immediately off the bat, and that's going to save this amount of time, X amount of cost. That's so important. So yeah, just keep educated, and it's not an area that ever really slows down in terms of the innovation and developments that happen in this space. So it's really important to just kind of keep up to date with the latest developments.
Well, we've come to the end of this podcast episode. A big nod of gratitude your way, Paul and Ben, for your informative and valuable analysis. We would also like to thank our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a terrific week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.